Scroll through TikTok, watch a YouTube short, or open X, formerly Twitter, and you'll hear the same thing.
If the Fed just cut interest rates, housing would be affordable again.
But here's the truth. That's a half solution to a much bigger problem. In today's video, we're going beyond the hot takes. I'll break down why low interest rates won't fix the housing crisis on their own, how inflation and policy have changed the rules, and what it really takes to make homes affordable again.
Just this week, the 10-year Treasury yield spiked by nearly 10 basis points, breaking past 4.49%. If you're watching markets through real-time threads on X or finance updates on Reddit, you know this was a big moment. The jump followed new CPI data showing inflation heating up again, far above the Fed's 2% target. That spooked investors who now expect inflation to stick around longer. And when investors get nervous about inflation, they demand higher returns, pushing yields up. Higher yields mean higher mortgage rates, since 30-year fixed mortgages closely follow the 10-year Treasury. That's why mortgage rates, which were under 3% in 2021, have more than doubled. They crossed 7% in 2023 and have stayed above 6% ever since. You might hear housing influencers on Instagram Reels or YouTube breaking down affordability as if it's all about the rate. But that's just one piece of the puzzle. Even if rates came down tomorrow, that wouldn't fix the deeper issues. Owning a home involves more than a monthly mortgage payment. You're also paying property taxes, insurance, and coming up with a down payment, all of which scale with the home price. The real problem, home prices have gotten completely out of sync with incomes. In 1985, the median home price was about 3.6 times the average household income. By 2023, it was 5.3 times. And here's a simple example. $500,000 mortgage at 3% equals $2,100 per month. At 6%, it jumps to $3,000. But that doesn't include taxes or insurance, both of which rise with the home's value. And the down payment? Also larger, also harder. If you've been watching macro analysts on Substack, finance YouTubers, or economists on podcasts, you've heard it. The Fed's easy money policy blew up housing prices. Between 2008 and 2022, the Fed kept interest rates near zero and bought trillions in mortgage-backed securities. That pushed demand sky high, not just from families, but from investors, hedge funds, and big institutions. It created a bubble where homes seemed affordable only because borrowing was cheap. Once those rates ticked back up, the illusion popped. And yet prices are still high because supply is tight, and sellers don't want to give up low-rate mortgages.
Let's talk about the latest hot take on X. Bill Poulter, from the famous Poulter Homes family, recently claimed the Fed is to blame for the slow housing market. He says if Powell would just cut rates, we'd see homebuyers flooding back in. But Poulter's wrong on two counts. 1. Low rates alone won't fix affordability. 2. The Fed may not even have the power to lower mortgage rates anymore. Long-term rates, like those tied to mortgages, respond to inflation expectations, government debt, and investor confidence. In fact, last time the Fed cut its policy rate, mortgage rates rose, the bond market saw inflation risk and demanded higher returns.
So, what's the real solution?
It starts with unwinding the years of asset inflation. That means reducing federal deficits, ending emergency monetary stimulus, letting the Fed shrink its balance sheet of mortgage-backed securities. The hard truth? That would bring home prices down. And that's exactly why it's so controversial. Wall Street and big developers have made fortunes from inflated assets, and many in power don't want that to change.
The next time you hear someone on X, TikTok, or a housing podcast say, "Just cut rates and we're good,"
you'll know better. We need structural fixes, not just cheaper debt. If you found this video helpful, please hit that like button, subscribe for more real estate breakdowns, and comment below. What's your prediction for the housing market in 2026? Crash, recovery, or more of the same? I'll see you in the next one.